To quote Allen Iverson, completely out of context, when it comes to the economic impacts of global warming and climate change, this is not a game, and we're not talking about practice anymore. Climate change is no longer a tomorrow thing. It is definitely a today thing. Just wait until you have to re-up your homeowner's insurance policy. As we know, the Federal Reserve claims they like to stress test the banks every 6 months to a year. But it looks like this latest round of rate hikes is the big stress test in real time on the consumer. And mortgage rates, the great disconnect of 2023 continues between treasury yields and the mortgage-backed security market, aka home mortgage rates. Welcome back to This Week in Mortgage, everyone. I'm Sam Battaglia at Mortgage Black in Beverly Hills. I hope you had a great week. All right, global warming, climate change. To quote Michael Douglas now, we gotta stop walking around blind without a cane. Hawaii's basically burnt down. There's a hurricane named Hurricane Hillary headed to California, but we don't have warm waters on the Pacific, or at least we didn't. And get ready for your insurance rates to go up on your home. As we understand, insurance is basically a big pool of money that the bean counters build in certain numeric anomalies for in the worst case scenario, so they'll have enough money in that pool of the people paying into it to pay out on insurance claims. Well, here's the problem. The bean counters cannot predict that we're going to have a 1 in 1,000 year storm every 6 months or so, or a 1 in 1,000 year weather or climate event every 6 months. They can't predict that. Well, there's going to be a bunch of things that happen because of global warming and climate change. Number one, it's going to hurt the affordability of a home or a structure in the United States because you have to pay more for insurance. And when you're getting a mortgage, the insurance is built into the debt-to-income calculations. Not good. Because of this, for things to come more in line with affordability, home values and property structure values have to come down. Well, in turn, this destroys household wealth because, as we know, the majority of people's money, wealth that they feel, is wrapped up into their house, which then in turn hurts consumer confidence. This is a vicious cycle, and it needs to stop now. Couple things on your insurance for your house. Could be the luck of the draw that whoever your carrier is doesn't have that much exposure to the natural disaster areas. A bunch of people pulled out of California. I'm guessing when things settle, the places they remain, those policies might go down those premiums, but who knows, because they're going to push the envelope as much as they can. And with all due respect, they have every reason to, because we're having 1 in 1,000 year storms or weather events that happen, seems like, every 6 months. So what's going to probably end up happening is the rest of the country is going to be very similar to the state of California, where the state of California, the government here, has to subsidize a lot of homeowners' insurance policies for a lot of different things because there are not a lot of carriers that want that kind of exposure. So usually as California goes, so does the rest of the country moving west. As New York goes, which Manhattan is sinking, California moves east, New York moves west, Florida, for that matter, moves up and west. The rest of the country is probably going to have to follow suit in some places where the government is going to have to subsidize homeowners insurance for people. And this, when you look at it from a macroeconomic perspective, is not good, no matter how you slice it or dice it. Moving on to the Federal Reserve, the rate hikes they did are a real-time stress test on the consumer every time the consumer pays a bill that has credit tied to it. So, as we know, we discussed last week, the U.S. consumer for the first time ever went over $1 trillion worth of credit card debt. It's an insane number. But I will say this again, the only inflation, for the most part, left in the economy is the payment inflation that the Federal Reserve 100% did create to fight the inflation on a bag of potato chips, for example, as I've used before. So, the Federal Reserve is the main culprit of the inflation. It's the payment inflation for goods that were much cheaper not that long ago. And it looks like a soft landing for the Fed, so I will give them some kudos when it comes to that. But they will have to start cutting rates sooner rather than later. And it looks like they've gotten the rate hikes out of the way, and they've got about 525 basis points to work with. And as I mentioned before, they probably know more than we do. We are Pavlov's dog. They know that. And the pen is mightier than the sword. So if they hint at cutting rates, things will instantly get better, especially the disconnect between mortgage rates and mortgage-backed securities, which leads me into the great disconnect of 2023, which continues on with these insane spreads. So here's the deal with mortgage rates. Rates are high, of course, but they're artificially higher than they should be or need to be for that matter. Well, I should only say should be. They need to be because of fear. So rates are high. They're being made artificially higher because the belief by a lot of investors and money centers is that rates will come down sooner rather than later. So the way some of these banks look at it is, hey, we don't want to lend at these high rates because it's not worth our time, because it's going to be getting paid off because rates went up so high so fast, and gravity, as everybody knows, always kicks in. So when a bank charges an extra premium on top of an already high interest rate, selling begets selling, fear begets fear, and they got to make it worth their time to lend the money, so they're going to go artificially higher than the market needs to call for based on treasury yields. And the spreads right now between treasury yields and mortgage-backed securities is way overinflated. All things being equal, that should come down. And as I've said, fear begets fear, higher rates beget higher rates, and they do end up becoming a self-fulfilling prophecy, and that's exactly where we are right now. And as I mentioned last week, when are interest rates going to come down? Interest rates are going to come down when they're supposed to come down. Okay, everybody, that is my show for this week. As always, thank you for your time. I hope you enjoyed it. Please have a safe weekend. Apparently, we've got Hurricane Hillary on the way to California. Interesting, over the Pacific Ocean, which is really cold, that we're going to have a hurricane. We will see how that shakes. Everybody, please stay safe. And, always thinking about the people in Hawaii. Devastation is an understatement. Okay, everybody, thank you for your time. Enjoy the